Hi, this is Heiko speaking. Today we talk about Fed meetings, and the Fed, obviously the Federal Open Market Committee is the central bank of the United States, holds meetings around 8 to 10 times in a year. In the year 2015, we had 8 meetings, and 2016 is also announced. The calendar also will be 8 meetings of the Federal Reserve Bank. You can also surf, or you can Google those Fed meetings. Just put in Fed calendar to Google, and then you will have this the the historical meetings and the meetings for the current year on this website here. So we will have a look at the impacts on the markets, and obviously the Fed is is a very powerful force in the marketplace, and so whatever the Fed is doing and whatever the Fed is saying has an impact on the marketplace, and we see how the bias, how the market react on those events. Uh, I put 6 markets together which are very sensitive to Fed decisions. Here we have the S&P 500, which is the biggest stock market in the world, the stock market of the US. We have the US, which is the USB. This is an ETF of the bond market, of the 30-year bond market of the United States, which is very sensitive to Fed decisions. Obviously, we have the oil market here, we have the gold market here for commodities and for the precious metal sector. Here's the dollar index, obviously, and the euro dollar. So now let's check how the markets react on Fed days. First, we have a look on the obvious, on the US dollar, and how is the dollar reacting around Fed days. We see here whenever the black arrow occurs, we have a Fed meeting and we have an entry on this day. And when this white arrow occurs, we have the exit of this, if you want, trading signal. Now I show you the market reaction of the US dollar, and if we see the performance summary, the performance graph, it is negative for the US dollar. This would be the case. This would your portfolio be if you would buy a Fed on a Fed day the US dollar index. So and you would sell it. I have to check it here. 2 days later. Um, this would be the performance graph, your performance of the portfolio. So it is dollar bearish, more or less, a Fed day. And you see here we have 44 Fed days, which means, or 44 events, which means we go back for 9 years approximately in history. So the summer, here's the exact date, 2007. It's not 9, it was 8 years. So we have in summary negative for the dollar. So when it's negative for the dollar, it should be positive for the euro. So let's check this. I clicked on the euro, and indeed it is more or less positive for the. Now we have the right curve. It is more or less positive on the euro, a Fed day. This is the portfolio curve. If you would have buy the euro on a Fed day, and you would have sell it 2 days later. And you see this is an upward sloping curve, not a perfect curve, but more or less the impact on the euro is bullish on a Fed day. So this in mind, we have the next market, which is the oil market. Let's have a look at the oil market. And now we see how the oil market reacts on Fed days. It is not as convincing as the euro or the dollar. It is more or less going sideways without any tendency. So the oil market, I would say it's a neutral market on Fed days. We had this upward slope here, but this is this ended, if you want, 2012 or maybe 2013, but it's not currently up to date. So I would say that at the moment there is no real impact, no real predictable impact um, from Fed days to the oil market. Next market is the gold market. The gold market is more or less similar than the oil market. Similar in the conclusion. We saw an upward slope until 2013. Then it portfolio went down until 2014. Now it's creeping up again, but more or less this really clear bias, what we have seen from 2.7 until 2.13 is not as present anymore. So my advice would be not to trade the gold market around Fed days, or if you trade around Fed days, you can trade, of course, but not on the basis of this chart of this event what I present here. You can trade it on any different technical indicator or chart pattern or what, but not on this seasonal if you want impact. Have a look on at the bond market. How does the bond market react on Fed days? And we see here a positive bias, so a good bias. The yields are going down. The bond market is going up normally on Fed days, and we see here a clear bias to the upside. So the bond market is a good market to go long on Fed days. If we see it's a good statistical report. We have a profit factor of above 3. We have 66% rate of win. So it's a good number, and it's a good slope for the portfolio for this pattern in the bond market. And here the rules: you buy 2 days before the Fed holds its meeting, and you buy 2 days after the Fed has his announcement. So the holding period is approximately 4 days, and here is the 4, and here is the we have a very clear impact, and I really would recommend to trade this this event in the bond market. Last but not least, the stock market, S&P 500. What happens if you buy the stock market around the Fed day? And you see it on the numbers here. We have a profit factor of close to 3, which means that you have a €3 gain for every dollar or for every euro you lose, which is a very good number. We have close to 70% winning rate, and the performance is good. It's a very upward sloping curve, and it's a really nice curve. It's a very clear trend what we see here, and from all those equity curves you have seen in the last minutes, I think this one is the best here of the US stock market. This one is the best. The second best is the from the US bonds. So those two markets I recommend to go long on around the Fed days. And now the exact rules for this pattern for the stock market: go long 2 days before the Fed day and exit 1 day after the Fed day. This is the rule. We go long at the open, and we go, of course, we exit also at the open of this respective day. So for any questions, just drop me an email. I will respond to it, and I also will put some report on the website where the rules are described in more detail. But this should be the general guideline to trade around Fed days. The best market is definitely the stock market and the bond market, and beside that, a more bullish tendency in the euro and a more bearish tendency in the dollar, and then, in my mind, a neutral, not predictable tendency in the precious metal and the commodities market. That's it. See you next time. Bye.